Hmm. All right, here we are again. Looks like everyone's here. Good. All right, so I have good news. The Mind Tap has finally been set up correctly. We had a bit of a problem there. I think it's because everyone involved in this process was on vacation last week. So finally, it is available to us. Let me just show you what needs to be done. So if you go into Brightspace, at the top, there's in our normal set of notes and everything, we have this one module, as it's called, which is known here as MindTap. I just chose MindTap just so it's obvious that this is where you're supposed to go. And you can see the others are here too. You've got the syllabus, and these are the links in case I forget to send them out. And then these are the chapters. They're all here. I believe I've finished all of them. The only thing that's missing here is the exams, but I'll get those done fairly quickly. So everything is already here that we'll be doing for the rest of the course. And so now, as far as the MindTap goes, first of all, what is MindTap? It's a system. Let me actually show you what it looks like before we talk about setting it up. In my MindTap account, I've got, as you can see, multiple courses going on here. The one that we'll be using is, of course, MFIN5502 Financial Markets. It's the only one section, so it's called Section 1. Now, once you have it set up, this is what you're going to see. You click it on, and this is where you'll find all of the assignments as well as the exams. Okay, so in other words, since everything's being done online, this is how all of the assignments will be completed as well as the exams. So what you'll see here a list of topics. These are the parts of the book. And before we even go to the assignments, if you come over here, the very bottom, here it is. The textbook is right here, full book. Okay, so you'll actually have a copy of the book. And here's the table of contents, of course. And so if you want to read the book, here it is. And actually, that can be very helpful because when you start to do the assignments, they'll often offer you an opportunity to link back to the book in case you've forgotten what they're talking about in the assignment. So the idea behind MindTap is that they're giving you assignments to work on, but they're trying to give you as much help as possible. So one of the ways they do that is to give you direct links to the book to refresh your memory in case you've forgotten something. And you can also, of course, just read it directly. The book itself has a bunch of its own links. And so that is one of the important things you need to know. But as far as the assignments are concerned, those are over here. Now, here we have to be careful. The best way to see the assignments is to look at this little calendar icon. Okay, so if you do that, you'll notice that there's a bunch of assignments listed here with due dates. And they all have this little red dot, which reminds you that this counts towards the grade. Now, of course, since this class only runs for 5 weeks, it's a little bit tricky to squeeze in a large number of assignments, but each week there should be 3 or 4 of these ready to go. And if you notice in week 5, nothing is listed here because that's the week that we'll be doing the final exam. So that's the part that's not quite finished yet. The rest of it is already here. And in fact, if you wanted to, you could actually start these ahead of time. They're all open as we speak. You could literally open these up tonight if you wanted to and work on them. But the deadlines are listed here. Now, because it's a summer class and because we really just got started, the deadlines are not as rigid as you might think. For example, these are all technically due on Sunday night, the 1st. Now, you see these little L's here. It's set up so that if you can have up to an extra week to get these done with a tiny little penalty of 10%, a little late penalty of 10%. That way you have an incentive to finish it on time, but something goes wrong, you don't have to feel like if they're not done by the due date that you'll get a 0 or something like that. That's not the way it's going to work. So you'll have an official due date. You'll have the opportunity to finish within a week with a small late penalty. Or if there's a genuine problem, for example, your job sends you on the road or something, or if you're on vacation and things like that, you can just let me know and I can do something about your due dates because I know it's the summer and a lot of things might come along that would prevent you from getting your work done. But here's the setup right here. So in other words, we have these three. And what's interesting is that sometimes they give you an estimate of how long it should take, and sometimes they don't. I'm not quite sure why. But I don't think these three should take you more than a couple of hours at the most. At least number two here, if you look carefully at the questions, it's just taken straight out of chapter two. And, they're pretty much straight ahead fill-in questions. Some of them might be true or false. And now here's the beauty of this setup. If you get something wrong, you'll have up to 3 opportunities to try it again. And when it's done, when you're finished, it will take the best of your scores. Okay. So in other words, let's say you go through it once and you say, oh my God, what was I thinking? I got them all wrong or I did something wrong. It's set up to give you multiple opportunities, 3 altogether, and it will give you the best score of the 3 that you attempted. It will also give you feedback as soon as you're done with it. It should tell you what went wrong if something did go wrong, and that way you can try it again and try to improve your score. And so also it should have videos linked to it. If you're not sure about a concept, either it'll send you right back to the pages in the book that you need to see, or else it'll show you a video that will help you understand what's going on. So it's, again, the whole thing is designed to be as user-friendly as possible, to be helpful, to give you a lot of encouragement, to give you feedback. And so it's been my experience that usually people do very well with these mind tap assignments. And now, if something goes wrong, let's say that you run through it and you keep getting the answer wrong and you're not sure why, you can just send me an email and I can help you figure out what the problem is. Very, very, very occasionally, they do actually have a mistake in here. It does occasionally happen. And if that happens, I can just give you the points back because I have complete control over the grading. But usually it's a matter of maybe it not being as clear as it could have been, what it wanted. Sometimes there are issues with rounding, for example. All kinds of little things can happen. So just let me know, okay? And then I can take care of it. So here's what we're looking at. And you can see it's a fair amount of work, but it's not going to be overwhelming. And then at the end, we'll have an exam where I will sneak it in there as soon as it's finished. And that will wrap up the course. Okay. So I believe the grade is coming. Oh, except for these, later on in the course, we will have a couple of Excel assignments, but that will take care of the entire course. In other words, MindTap will be most of the grade, and then the rest will come from those Excel assignments, which we won't have any just yet. It'll take a while before we get to the material that really requires Excel. Okay, so now here's the big question. How do you get your hands on MindTap? That's the big issue. So we go back to Brightspace. Now this is, you notice how it says external learning tool. This is a link. Now, I don't know what's going to happen if I click it on because I already have this, but when you click it on, it's supposed to give you the opportunity to register for the MindTap. And I've been told that it's only going to offer you one package deal. Unfortunately, there is a cost involved, but it's like $100, but it does include the book. So it's a bit of a nuisance, but it can't be helped because we're online. There's nothing else we can really do for assessments. So it will ask you to pay for it, but hopefully your boss will cover that or something. But it's not a huge amount of money. It's like $100, $120, something like that, and you'll have access to the book. You'll probably have access to the course for a while as well if you want to, keep reading up or doing something with it. So once that's set up, then you'll have complete access to the MindTap and you can do the assignments. And like I said, they're all set up so that you can open them up immediately. What separates them all is their due dates. Okay. So that's that. Now, given how late in the week we were able to get this set up. What I was thinking about possibly doing, let me make a note to myself here, is maybe for the first week at least, extending all the due dates. Just because, it's already Thursday and they're technically due on Sunday night. That's probably pushing it a little. So after we're done tonight, I think I'll add several days to that due date. Just because of this, under the circumstances, I want to make sure you have plenty of time to finish everything. Okay, good. So and you'll get used to this very quickly. It's pretty straightforward. It's largely self-explanatory. There are certain things you got to watch out for. Like I said, be very careful if it asks you to round something to three places, make sure you round it to three places, that kind of thing. But I find that it's a pretty straightforward system to use. All right, so that's that. So now that that's out of the way, we can get back to the new material. And so if you recall, we're in chapter 3. We're very close to being done with it. We're going to take a quick look at these theoretical discussions about the term structure of interest rates and a little math. And then we can start looking at the Fed, which really is a very fascinating organization. And so these are theories that have been tossed about in the economics profession for many decades, really, about why the term structure of interest rates is what it is. So we look in the Wall Street Journal and we take a look and we say, well, today the yield curve, the treasury curve looks like this. Let's take a look at today's. And it does bounce up and down. It depends what's going on in the market. Some periods of time, the markets are much more volatile than others. Right now, they're kind of a little nervous. But so here's CNBC, one of my favorite financial websites. So the markets are closed. So what you're seeing here are the futures prices that reflect what traders what we think will happen tomorrow based on the activity of traders in overseas markets. You can see the treasury, the 10-year yield went up just ever so slightly. That usually is in oil, just a pinch. The markets are a little nervous, but not very nervous right now. We did have a good earnings from NVIDIA. It should be here somewhere. Costco did well. I guess people were nervous about NVIDIA and their fears were unfounded. So the markets did pretty well today. So anyway, so we're going to come back. Oh, yeah, I forgot to get the yield curve. Here it is. So this is the curve you're looking for, the daily treasury par yield curve rates. So these are the yields to maturity on the all the securities issued by the United States Treasury Department. And so as of today, this is what it looks like. You can see it's kind of flat at the short end of the yield curve, and then it kind of dips down for a bit, and then it starts to spike back up again. This is not something you see normally throughout history, this dip in the center. But when things are not normal, when things are like unusual, like they are now, you do start to see these very bizarre shapes for the yield curve. But like I said in the past, normally the yield curve tended to be just upward sloping. But in recent years, there have been a lot of cases where the yield curve had other bizarre shapes. And again, that's typically a reflection of uncertainty. So anyway, so the question is, why does the yield curve look like this? What's going on here? Well, there's a lot of information contained in these yields. Now, the Federal Reserve is, responsible ultimately for the short end of the yield curve. The monetary policy affects directly the short end of the yield curve, but the rest of them are being affected by supply and demand conditions in these different markets. So, for example, you might expect that different market participants are buying and selling short-term treasury securities, and others are maybe buying longer-term treasury securities. So one of the theories we'll be looking at explains the yield curve by saying that basically the market for each of these maturities is actually a separate market, that they're almost independent of each other. But here we're going to start instead with this notion of the pure expectations theory. And basically what it's telling us is that the long end of the yield curve is being driven by where investors expect short rates to be in the future. Okay, so in other words, if I look at this curve, this 492 reflects where the market sees the shorter rates in the near future. This means that this is a forecast by the market that short-term rates are heading up in the future. Okay, now whether that proves to be true or not, if that's what investors are expecting right now, that is what's going to drive this yield up to 492, according to this theory, that is. Okay, so what's going to happen here? And by the way, I think we mentioned this the other day. Just in general terms, let me just mention this again. And we'll get to this discussion fairly quickly, but the price of a bond is inversely related to its yield, which is more formally known as the yield to maturity. Okay? The yield to maturity is the rate of return to holding a bond, or in this case, a treasury security. If a bond is held to the maturity date and all interest payments are reinvested, same rate of return. Otherwise, the actual rate of return to the bond will be somewhat different. Than the yield to maturity of the bond. So if I buy this 30-year treasury bond and I do not reinvest the coupons, my actual rate of return could be different than 4.92%. But it's a very good first approximation to the actual return I'll get by owning this thing, because it reflects the interest payments that I'm getting, as well as the price of the bond in the marketplace. So we're going to see in a later chapter exactly how to calculate a bond's price and its yield to maturity. But for now, just think of the yield as the approximate return to owning this bond. And just be aware too that, let me just mention this here, at least in the US Treasury market, the securities with maturities of more than 1 year provide investors with semi-annual interest payments, which are known as coupons, until the maturity date, at which time the investors are repaid bonds face value. Okay, so in other words, the bond is issued with a face value, which is typically $1,000, okay, or some multiple of 1,000. So it's like if you buy a 30-year treasury bond today, you're going to pay $1,000 for it. And for the next 30 years, you'll get semi-annual interest payments or coupons. And then at the end of the 30 years, you'll get your $1,000 back. Okay, this is how they're structured. The securities with maturities of less than a year are instead sold at a discount to the face value and then redeemed at the full face value. So in other words, what does that mean? Let me just give you a quick example. This Copilot. All of a sudden, every time I turn around, it's offering me to do Copilot, and I have no idea what that means. Suppose that an investor buys a 1-year treasury with a price of 970 and a face value of 1,000. Okay, so this means that at the end of the year, investor will receive $1,000 based on an investment of 970. This means the investor received a capital gain of $30, and the rate of return is 30 over 970, which is, hold on one second, 3.09%. Okay. So if you looked in the Wall Street Journal for the security, it would show a yield to maturity of 3.09%. Okay. In other words, if you look at this chart, all right, well, of course, I completely made up that number. It's actually 392, but this is how they figured it out. And so you're getting a $30 profit by owning this security for a year. And so that works out to a 3.09% yield or rate of return. So that means that the short-term securities are providing you with a capital gain. The longer-term ones are providing you with actual interest payments throughout the lifetime of the bond. So that's pretty standard because, it makes sense that you don't want to send out coupon payments to securities that are going to mature very soon anyway. So that's why it's done this way. And then one more thing I want to mention here, the convention in the markets is that as far as the treasury market is concerned, the securities that are traded there actually have different names. If the maturity is less than 1 year, or 1 year or less, I should say, these are known as treasury bills. So if you read in the Wall Street Journal, they're called treasury bills. 2 years to 10 years are called treasury notes. Now, I don't know how this came about. And 20 to 30 years are known as treasury bonds, but technically they're all bonds. I mean, if you call them bonds, you're not wrong. It's just that the convention is to call the short-term ones treasury bills, the intermediate ones treasury notes, and the long-term ones treasury bonds. So that's how that works. Okay, so these are the two that provide interest payments, and these are the ones that are sold at a discount. And now, as far as who buys these, the short-term ones, the treasury bills, are actually a great way for corporations to park their money for short periods of time. Let's say you're Starbucks and you're thinking about investing $10 million in building some new Starbucks in Europe. While you're trying to decide what to do, you keep the $10 million invested in treasury bills because you're earning some interest more than you would get in a bank account. But as soon as you change your mind and say it's time to start investing this money, you can easily sell the treasury bills in the market because they're very, very liquid. So it's a great place to invest short-term funds and earn some interest before the money is actually needed. The longer-term ones would be for investors who are thinking in the long run, like people who are investing for their retirement might buy treasury bonds because, of course, that's going to be many years in the future. So there's different, investors, different market participants who are interested in these different maturity segments. That's why there's so many of them, by the way. If you look in the corporate market, they tend to only have a few maturities to choose from, like 10, 20, 30 years is more normal. The reason why these are all available is just because people want them. I mean, the Treasury is trying to borrow your money, so they're going to make things convenient for you. In fact, it's gotten to the point where you can actually buy treasuries online. You can set up an account with the Treasury Department and you can buy treasuries in increments of as little as $100. So they're saying, please, please, please buy these. We'll do whatever it takes to make it convenient for you. And you get tax breaks with these. These are not taxable by the state or local governments. So there's a lot going on here that makes them attractive to investors. And in fact, that's one of the reasons why so many foreigners actually own treasury securities. It's a huge market to say the least. But anyway, so these numbers are what we mean by the term structure of interest rates, and the graph is what we mean by the yield curve. Okay. So, I mean, you could sketch this out if you wanted to, but you can see for yourselves. I mean, clearly it's falling in the center and then rising again. Not what we used to see in the past. Okay. So, see, we can have like flat, we can have rising, we can have falling. Anyway, so with the expectations theory, the idea here is that, well, investors are they're owning the bonds. Of course, they'll maximize their rate of return, but um, the reason why long rates are higher than short rates is because investors expect rates to go up in the future. And that means in order to hold longer term securities, they need to be compensated with a higher rate of return. Okay. So one of the things we have to remember is that long-term bonds prices are more sensitive to changes in interest rates than the prices of short-term bonds. And we'll see exactly why that is. I think it's chapter 8 when we start talking about the bond markets. So in other words, if investors expect higher rates in the future, they will not hold longer term bonds without a higher yield to compensate them for their risk. Actually, it really goes both ways. I mean, it just in general, when investors will require a higher return in the future for longer term bonds just because of the extra risk involved. But according to this theory, investors will hold whatever maturity makes sense based on their expectations of what's happening in the future. So we have to assume that investors in this market don't care particularly whether they're holding 30-year bonds or 1-year treasury bills or anything in between. It makes no difference to them whatsoever. Okay. Now, in practice, that's probably not true. Some investors are more interested in the 30-year bonds, depending on their investment horizon. Some are more interested in the 1 years and the shorter ones. But if nobody cares, if they're all indifferent between them all, and they're simply trying to maximize the rate of return, then the curve itself should reflect what everyone thinks will happen in the future. So here's an example. An investor, in this case, who needs to save for 5 years would be indifferent between the following 3 strategies: buying a 5-year bond in the first place, buying a 10-year bond and selling it after 5 years, buying a 30-year bond and selling it after five. It makes no difference to this investor. Okay. They're going to choose the strategy that they believe maximizes the rate of return. Okay. So here's a numerical example of this. Suppose that the 1-year rate is 9%. Now, this is again based on the treasury market. This would be the yield on a 1-year treasury bill. For the 2-year treasury note, it would be 10%. And the fact that the 2-year rate is higher than the 1-year, according to this theory, it simply means that investors think that next year short-term rates will be higher than they are this year. So here's the numerical explanation of this. So you could, if you had money to invest, you could simply, let's say you've got a 2-year horizon. You want to save money for some event that will take place in 2 years. You can buy a 2-year bond, or you can buy a 1-year bond, and when that matures, you can take the proceeds and reinvest them in another 1-year bond. Okay. You'll still have money saved up in 2 years. The thing is, this one introduces some uncertainty. This one lets you lock it in. You can imagine doing this in a bank as well. I mean, you could buy and enter into a 2-year CD. I guess everyone knows, I mentioned this here. in case you haven't heard of this before, a CD is a bank deposit in which the investor must leave the funds at the bank for a fixed length of time. So it's like a savings account where you have there's a minimum time you have to wait before you can get your money back. So why would anybody put themselves through this? These CDs provide a higher rate of return than ordinary savings accounts as a result. Okay, in other words, they're rewarding you. They're saying, listen, if you can commit to leaving your money here for 2 years and you swear you'll never try to take it back, we can give you a higher rate of return. Okay, it makes sense for them because it's easier for them to take this money that's locked up and lend it out to other customers at a higher rate of interest. So it's helpful to the bank to have this money locked into place. So they're offering you the chance to get more interest if you're sure that you won't need it back. Now, in practice, if you're having a true crisis, they'll usually let you have it back. Like if you have to go to the hospital or something, but it's not going to be convenient. So something like that, you can also use these to illustrate these same strategies. But let's just say that this investor can either buy the 2-year treasury note or else buy a 1-year treasury bill and in 1 year use the money to buy another one. So let's say, now remember, we already saw that the 2-year treasury note is paying 10% right now. So after 2 years, and again, you notice how the money is assumed to be reinvested. We're not taking the cash, the coupon payments and spending them. They're being reinvested. So we end up with 21% rate of return over 2 years. Or in other words, every dollar that we have now becomes $1.21. All right. And how did we get that, by the way? Here's your dollar. You reinvest it, and then at the end of the year, your $1.10 is reinvested at 10% again, and that gives me $1.21. Okay. Or you could think of it as $1.10 squared. Okay. Now, on the other hand, if you buy that money, I buy that 1-year treasury bill for 9%, and then you roll it over in 1 year, we don't know what X is. That's the rate you'll get next year. So in order for you to be indifferent between the two strategies, we can solve for X and discover the rate of interest at which investors are indifferent between holding a 2-year treasury note or a 1-year treasury bill and rolling it over into another one. And so if you go through the algebra, you'll see we end up with 0.11 or 11%. So in other words, 1.09 followed by 1.11 is the same thing as 1.10 followed by 1.10. So remember, we're assuming that investors are indifferent between strategies of different maturities. So in order to be indifferent between the two strategies, that means we must expect to get 11% in 1 year. So investors expect the 1-year rate to be 11% next year. According to the theory, and if this is correct, if investors are truly indifferent between investments of different maturities, then that's exactly what would be happening. And of course, if there's no credit risk, which would be true in the treasury market anyway. Now, by the way, if you're interested, we can do the same thing for when we expect rates to go down. Let's say Oh, okay. I guess we can invent one right on the spot. Suppose instead, the 1 year rate is 9% and the 2 year rate is 8%. So the yield curve is sloping down. What does this suggest about expected 1 year rate next year? All right. Well, investing for 2 years will bring us, let's say we invest $1. In 1 year, we'll have $1. Oops, 166. Now, if we try the 1 year strategy, where we invest for a year at 9 and then we roll it over, whatever this number is, it's going to be less than 9%. That's the important thing. Okay. So it's going to prove to be 7, 7.01%. So in other words, the fact that the 2 year rate is below the 1 year rate indicates that we believe the 1 year rate will only be 7% next year, according to this theory. Okay. So again, but this is of course based on a lot of strong assumptions, but this is one possible explanation for the shape of the yield curve. Just straight ahead expectations. It goes up. If we expect rates to go up, it goes down if rates are expected to go down. Now, oh, I did have another example. I didn't realize it was in there. Okay. Well, I did a lot of extra work for nothing. Okay. Now, now here in the book, they've got all these curves that tell us when expectations change. This is the supply and demand explanation for what we were just doing. If we expect higher rates of interest next year, you can see that in the short-term debt market, and they're using 3-month Treasury bills for their example, the supply of funding goes up. If you really think rates are heading up, you want to save more money, right? But on the other hand, people won't want to borrow as much because they're worried that it'll cost them more. So the demand for funds goes down in the short-term market. In the long-term market's the other way around because um, you're expecting you're not going to want to save as much, but you will want to borrow more before the rates go up, that is. And so the net effect is that what they're showing you here is that long-term rates went up. The short-term rates went down. And the result of that is a steeper yield curve. So they're explaining here in terms of supply and demand. Higher expected rates of interest indicates that long-term rates will rise and short-term rates will fall. Okay, because of supply and demand conditions. And then down here, it's just the other way around. We have lower interest rates we're expecting. So the long-term rates fall. and the short-term rates rise. So we have an algebraic explanation and we have a supply and demand explanation for the expectations theory. Okay. And again, so because when we expect higher rates next year, in the future, that is, um, you want to increase your short-term lending, but reduce your long-term lending. And as far as the borrowing goes, you want to lock in the rates before they go up. So you want to switch from short-term borrowing to long-term borrowing. Okay. So anyway, now we have to discuss this concept of liquidity. Well, liquidity is an interesting idea. I mean, what it really refers to is the idea that the liquidity of an asset refers to the ease with which it can be converted to cash. So you could probably imagine, like, for example, checking deposits are highly liquid. It's, now at this point in time, it's getting to the point where people don't really write a lot of checks anymore. In fact, um, now it's getting to the point where the undergraduates, I actually asked them if they've ever seen a check. I really, just because, I mean, many of them have had jobs and they do actually still get physical checks sometimes. If not, they get like one of these um, receipts that it looks like a check, but it's really just a receipt for your direct deposit. So many of them have actually been paid by check, but almost none of them have ever actually written a check. Um, it just it's too easy to do it online. It's like cash. I mean, it's kind of the point where you could just wave your Apple card over a reader device and pay for a Coke or something. It's just cash itself is kind of disappearing from the economy. In fact, fairly recently, I found myself. I had to go to the dentist, and they had these old-fashioned parking meters there, and I was like, wait a minute, do I still have quarters in my pocket? But then I looked at it very, very carefully. I got up close to the thing and I realized there was a little sticker there explaining to you how to log into this system where you could pay for it with your credit card online. But it wasn't obvious when I was getting out of my car. I was like, oh no, what am I going to do? I don't think I have quarters in my pocket. Um, it ended up not mattering, but you never know. So cash is kind of disappearing as well as, checking deposits. But you never know. There's actually the North White Plains train station, believe it or not, if you have to park there during the week, they require you to give them $8 worth of cash. And it, it you can easily imagine there's gonna be a lot of people who are like, wait a minute, what do you mean cash? What's going on here? So I would never leave the house without at least 80, $100 in my wallet, even if I never use it. But so checking deposits, of course, it used to be you just write a check and pay for things. You still technically can, but even if you can't, it's easy to get cash from your checking deposit. You write a check, go to the ATM, whatever. So checking deposits are highly liquid, whereas assets like real estate is highly illiquid since it is time consuming and expensive in terms of transactions cost to sell real estate. So you don't want to keep all your money in illiquid assets. Let's put it that way. So you're probably asking yourselves right about now, well, why would you own any illiquid assets in the first place? Very clear, very good reason. Um, illiquid assets have the advantage that they provide a significantly higher rate of return than liquid assets, such as you could probably imagine, cash, checking deposits, savings deposits, etc. But anyway, so liquidity refers to the ability to take an asset and convert it into cash very quickly. Now, it turns out that um, while the treasury market is highly liquid, but in general, bonds are not very liquid. Probably less so than stocks, let's say. Stocks are easy to sell. I mean, unless you've got some obscure stocks from companies nobody's ever heard of. Um, like if I have Apple shares in my account, it would be take no time at all to sell them. So, but if I have penny stocks, I might have trouble unloading them. So liquidity essentially is just a property of an asset, which refers to the ease of converting it into cash. So what they're saying here with this liquidity premium theory is that investors expect longer term bonds to be less liquid than shorter term bonds. Therefore, they must be compensated with higher returns or yields to hold longer term bonds, even treasury bonds. Okay. So that means there's going to be a bias towards an upward sloping yield curve. Okay. So in other words, um, I mean, even with a curve that's expected to be flat, let's say this investors expect the yield curve to be the same. Rates won't change in the near future. If they expect, though, some kind of a premium for investing in longer term bonds, then you're going to get this upward shape because let's say here's the 5-year maturity. The liquidity premium is, let's say, 1%. And then for 30 years, the liquidity premium is, let's say, 3%. So you're adding that on top of your expectations. Now, if you're expecting rates to rise, then that's going to make the curve get even steeper. LP for liquidity premium. And even if you're expecting it to fall to a certain degree, you might still have an upward sloping yield curve because of the liquidity premium. Let's say you're expecting this, it'd still end up here, depending on the size of these liquidity premia. So that pushes the curve up higher than it otherwise would be. Okay. So here's a quick, simple example of this. Imagine the following situation. We're going to predict the yield curve with the expectations theory and liquidity premium theory. So the 1-year rate is assumed to be 5%. Oh, here it is. The one-year rates are expected to be 5, 6, 7, 8, and 9, respectively. The liquidity premia are 0 for a one-year bond, 0.25% for a two-year bond, 0.5% for 3-year, 75 0.75% for 4 years, and 1% for 5 years. So the expectations theory says that the two-year rate would therefore be 5.5%. Based on, in others, here we reverse engineering basically the what we were doing earlier. Before we were saying we observed the 1 and the 2-year rates. What is the implied rate in 1 year? Here we're given the actual 1-year rate, and this is the expected 1-year rate. We're using that to figure out the current 2-year rate. But what they're saying is if with the liquidity premium, instead of 5.5%, we end up with 5.623%. Because of that little extra premium for the second year, the curve gets pushed up a little bit more than it did here, 5.5 versus 5.623. So that's really all that this is telling us, that on top of expectations, you also have to take into account the liquidity premia. And, studies are done all the time to try to figure out what is the liquidity premium and all this and that. It's kind of hard to figure out, how much of a yield comes from which source, but they try. And then finally, yeah, so they're basically just making the point here, like I did, that if you have the bottom, the blue liquidity premium removed means just pure expectations. With the premium, you notice how in each case it pushes the curve up because of the assumption that liquidity is lower with longer term bonds. Now, the market segmentation theory essentially is a theory that says that the supply and demand conditions for each maturity are different. Okay, so for example, the 30-year rate of interest is influenced by the supply and demand, among other things, for mortgages, whereas in the short end of the yield curve, a lot of that is driven by, investors who have money to save for short periods of time. So what that means then is that unlike the liquidity premium theory, where the liquidity premium is rising with maturity, let me just make a note here. Where the liquidity premium rises steadily with maturity, and this increases the steepness, let's say, of the yield curve with market segmentation theory. There can be a premium in each maturity range that does not necessarily increase directly with maturity. As a result, the yield curve can have any shape. So there's news coming out of the Wall Street Journal tomorrow that has something to do with the mortgage market. The long end of the yield curve is likely to be affected, but not necessarily the short end. Okay, so that's basically what they're getting at here. Actually, so that's 3, by the way. What is today, the 29th? So now we can finally move on and discuss the Federal Reserve System. In chapter 4 is all of the introduction, at least, to the Fed. Okay, so before we dive into the Fed, we're going to take a bit of a detour to discuss money. Now, of course, the Fed conducts monetary policy, which means they are ultimately in control of the money supply in the United States, which in turn directly impacts on interest rates. So we need to discuss money itself. Now, economists have a different way of looking at money than you and I might. You know, when you hear the word money, you think of the green pieces of paper in your wallet, let's say. But it's a much more general concept than simply green pieces of paper. And as you probably know, throughout history, there have been many different kinds of money that have been used. In fact, until relatively recently, gold and silver acted as a form of money throughout all of, let's say, I mean, the concept of paper money didn't really get started in Western Europe until maybe 1600s or so. Prior to that, all we ever had was gold and silver coins. And because money and gold and silver were considered to be interchangeable with each other, um, paper money only got started later on, although it's been determined if you look at Marco Polo's writings, he wrote about seeing paper money being used in China in the 13th century, if I remember correctly. Although it was backed by silver, you could take the notes that were being circulated and trade them in for silver anytime you wanted to. But the notes themselves contained a very strong warning, reminding you that counterfeiting was punishable by death. So they were worried about it even then, like this was going to be a real problem. In fact, if you look at the notes issued in the early colonial days, let me see if I can find a picture of one of these um, colonial paper money. I think it's death. I think I can find one. Oh no, what happened? I thought I had it. No. Oh, there it is. You can barely see it, but it actually says on there somewhere. There it is. To counterfeit is death. Because, let's face it. I mean, this after we broke away from England, I mean, resources were scarce, and paper money was apparently very easy to counterfeit. Um, and so that they were really terrified that the money supply would be destroyed. I mean, we're artificially inflated by counterfeit money. So they had to put that little warning on there. If you notice, it still says pounds because this is 1761. So it was a bit of a problem. Um, Eventually, they got rid of that and replaced it with "In God We Trust." So it went from one extreme to the other. Um, yeah, the United States, after the revolution, the United States was in a bit of a pickle because the US at the time didn't have any of its own deposits of gold and silver, and the British refused to sell it to us. So we had to come up with clever alternatives for our own form of money. But anyway, in fact, it got to the point where they were used. Spanish silver coins were being circulated in the United States side by side with American money because there was no silver. So, Spanish silver dollars became a very popular form of currency right after the American Revolution. And that actually lasted well into the 1800s. I think they only stopped that in like the 1850s. But Ben Franklin actually, as a printer, he did print money for the U.S. government. That was one of his jobs. But those notes that he printed did say to counterfeit his death. But anyway, so money throughout history has taken many different forms. And so we'll define money as any asset that satisfies three major or important qualifications. It must act as a medium of exchange, as a store of value, and as a unit of account. As long as it satisfies all three of those, we're good. Okay. So now, easily standardized, as far as the medium of exchange goes, it has to have its own separate set of properties. It must be easy to standardize it. So, in other words, gold and silver are perfect examples of this because it was easy to take coins and stamp the picture of the king on them and dates and that type of thing. So everybody recognized them as being valid coins. In other words, prior to that, people are using ingots, gold bars and that type of thing, and they had to be weighed and they had to be tested for purity. And so the advent of coins was actually a pretty important deal because suddenly it became possible to spend these coins without them being checked every time. They have to be universally acceptable, something everyone will recognize as a form of money. And then it must be possible to turn them into change. And this was a real headache for the American colonists because, again, they didn't have enough silver to make enough coins. And in fact, the Spanish silver dollar became a very popular alternative. The only problem with it was that it was a very large coin. It was worth quite a bit of money. So usually when you spent one, you're supposed to get some change. And by the way, these are the coins that were known as pieces of 8 because the Spanish real or silver dollar could be cut up to make change into 8 separate slices. And so this is how change had to be made during those early days because there was no other coins available. So literally they could be cut up into pieces of 8 like this. Wow. Now that's clever. That's ingenuity when you're saying, listen, we don't have enough coins, so let's just cut them up into little pieces. That will be our change. And so who cares what it looks like? The silver is the important thing. The weight of silver is what gives it its value. So if it's a little pizza slice, I don't care as long as it's got the right amount of silver. So that's one of the reasons why they were known as pieces of 8. Okay. Now, interestingly enough, prices then were quoted in eighths of a dollar. You'd walk into a store to buy something, and the price wouldn't say 10 cents or whatever. It would tell you how many bits it cost. Each bit was 1/8 of a dollar or 12.5 cents. And later on, eventually, when we started having enough silver to make our own quarters, quarters came to be known as 2 bits because they were worth 2 out of 8, 8 pieces of the dollar. And in fact, stock prices were quoted as fractions up until the 1970s, if I remember correctly, for that very reason. Prices were quoted in these fractional units called bits. Wow. So anyway, so these you can find these in museums sometimes. I mean, it's pure silver, which they're taking out of South America in those days. And so we also need it to be easy to carry and it needs to be durable. Now, here's an example of a form of money that's not easy to carry. In the South Pacific, there's a country called Yap. And this is the form of money that they use on Yap. These enormous stone wheels circulate as a form of money on Yap. Now, what's interesting about this is that nobody actually moves the coins, the stones around. They have record books, so they keep track of who owns which stones. So if you walk around on the island, you're going to see all these stones just sitting out there in the grass. Nobody's going to steal them because they're so heavy, but also because everyone knows which ones belong to who on the island. So there's no point in stealing it. And so this is the form of money that they came up with. Although at this point in time, they do use dollars too, but traditionally, this is the form of money that they used on that island. Now, it was a very small island, there aren't that many people living there. So, with such a small society, it's easy to agree to this type of thing, but well, it worked for them. And so you can find these in some US museums. They have one in the Smithsonian. But if you watch YouTube, there are videos where they'll walk you around and show you where all these stones are stored, and they're just sitting there, and they don't have to worry about theft. That's for sure. All right. Anyway, and one more thing is store of value means it maintains its purchasing power, which is what makes it possible to save. Without saving, there can be no investment, and so saving is absolutely necessary for an advanced civilization to take place. And of course, it provides liquidity. So we already know what liquidity refers to. We have liquid assets like, notes and coins, checking deposits, savings deposits. The ones in the middle there's some cost involved with cashing them in, or selling them. And then down here, these are the ones that are much more difficult to sell, or at least there's a cost involved. There's time involved, so they're much trickier to sell. But the advantage to them is that they do typically provide a much higher rate of return. So there's, you wouldn't keep all your wealth in real estate, but you also wouldn't keep it all in your checking account either. You need to have some of each. So, throughout history, like I was saying, gold and silver, they do satisfy all these requirements. And so for all those centuries, gold and silver were a form of money. And but there's been quite a few very interesting types of money as well. Um, for example, there were periods of time in Alaska where reindeer teeth were used as a form of money. There's a period in the colonial days when tobacco leaves were a form of money in um, Virginia and Tennessee, and there it depends on what's going on in that country, but there have been a lot of different forms of money. But gold and silver were the ones that were the most popular for hundreds and hundreds of years. Now, here we're going to see that the Federal Reserve has its own definitions for what is money, and they do depend on liquidity, basically. So, currency, meaning notes and coins, checking deposits, would be considered absolutely the most liquid assets in the economy, and therefore they must be a form of money. We also have stocks and bonds, CDs. They're not quite as liquid, and of course, really expensive assets like real estate, art, precious stones are highly illiquid, so they would not really be considered to be a form of money. We know that liquid assets are very convenient to pay your bills, but they usually provide a very low rate of return, if anything. Now, the unit of account gives us the ability to have prices. Now, you can probably imagine that before money was invented, I'm not sure if anyone knows how long humanity's been using money. Let me just see if we can come up with an estimate. This is interesting. Oh yeah, that's interesting too. They mentioned Bitcoin. I'm not sure if Bitcoin qualifies as money given all those definitions. Um, I'm going to say no. Yeah, there, shells in some island countries, shells have been used as coins as money. Chinese coins found in the 1400s. Wow. But I mean, I've read estimates that, even going back, even money originates even before Christ. But the thing is, why does that help us so much? Why does it help to have prices? Because if not, it's great that you can go into the supermarket and buy anything you want. Every price is quoted as so many dollars. But without money, you've got to resort to something called barter. You're trading goods for each other. So imagine you're trading lettuce heads for bottles of milk or something. You have to negotiate and come up with a ratio of exchange for every pair of goods in the economy, and that can be horrendously inefficient, as you can probably imagine. I mean, how many prices would there need to be if we didn't have dollars? It would be beyond belief how many there would have to be. And that when, by the way, when society in which there's no money, we have what's called barter. They just directly trade goods and services among themselves, and they just negotiate the prices for each transaction. But that is so horrendously efficient that you can easily understand why money came into being. So, and there's other. Oh, and that reminds me too. What's interesting about gold and silver and paper money is that the good thing about gold and silver is that, they have all these wonderful properties, but they are fairly heavy. And so when the West started trading with India and China and Persia and all these other countries, in order to avoid having to carry around enormous sacks of gold and silver, that's when some of the earliest types of paper money started to be used. But of course, paper money requires everyone to have confidence that, they do have some kind of value, that you don't have to worry about that with gold and silver. Everyone sees, oh yeah, it's gold and silver. I can always spend these. So of course, paper money depends on confidence. But if it gets to the point where it's convenient for everyone to use it, then start to see it being used. And so, a lot of the evolution of money comes down to just convenience. Now, here's an interesting side note. I think I mentioned this the other day. There are three, there are 12 Federal Reserve banks scattered throughout the United States. And it's depending on the bank, it's usually possible to make arrangements to get inside and either just visit or else get on a tour. The San Francisco Fed actually has a pretty extensive museum of American money. And so if you want to learn more about the history of American notes and coins, you can go there and see them in person. So does the one in Philadelphia, by the way, which is not too far from here. The interesting thing about Philadelphia is that they have not only their own Federal Reserve System with a museum of money, practically right across the street is one of the two US mints where they produce the coins. And then the buildings in which the first and second banks of the United States operated are in Philadelphia, and they're now open as museums. So the first, second national banks, the Fed, and the Mint are all within a few blocks of each other in the historic district in Philadelphia. So if you want to have a very culturally relevant vacation, let's say, or a very educational vacation, you certainly can check out Philadelphia. But the beauty of the San Francisco Fed is that their history, their collection, uh, oh boy, I think the link may have changed. American Currency exhibit. This is it. No, I actually was looking at this fairly recently. I know it's out there. Well, anyway, so if you could find the right link, you can actually take a look at pictures of a lot of historic U.S. notes and coins, and there have been a lot of really interesting ones. Um, what have they done? This is very, very annoying to me because, oh no, why would they? Oh, for God's. All right, well, I don't want to hold you all up all night here. I don't know what happened, but it's so ridiculous. You'd think that this would be the one thing that they would maintain or be careful with it. I don't think the ones in Philadelphia or Chicago are actually online, though. They do have their own museums of American money. So they're just mentioning that they have one. Oh, well, all right. Okay. Anyway, but there's all kinds of interesting notes and coins. Like I at this point, I usually like to show a few of the fun examples. Like for example, there once upon a time in the United States was a $100,000 bill. You probably would like to see that. In fact, we could probably go look at it anyway. There it is. Now, this is Woodrow Wilson. The people, the thinking of that, why is he on the $100,000 bill? Because he was president when the Fed was created in 1913. If you notice, it's a gold certificate, which means that if you had one of these in your pocket, you could go into any bank and demand to be paid $100,000 in gold coin, um, because you didn't trust the government to have this money on deposit. So that's why it's a gold certificate, and they produced these up until the Depression, basically. And then for many years, about 30 years after that, they produced silver certificates. We could cash them in for silver. In fact, I'm going to show you a very interesting one right now. Now there's Martha Washington. It says $1 silver. This is a silver certificate as well. This is produced during the Civil War. You could take this note into a bank and say, listen, give me $1 worth of silver. This is the only time in American history that a woman has ever appeared on US paper money, by the way. There have been women on coins, but never, this is the only first and last time a woman appeared on an American note. So that's kind of an interesting historical feature too, not just the fact that it's a silver dollar bill, a silver certificate. It's the fact that it's a woman, it's Martha Washington. And it even says the words, this certifies that there has been deposited at the Treasury of the United States $1 in silver coin, just to show you that the money is literally backed by silver. It's the paper notes are just representations of the actual silver that they swear is on deposit somewhere. You can cash it in anytime you please. So that kept going until the early 60s. And now the paper money is just paper money. It just says Federal Reserve note. It doesn't, there's no promise in there to back it up with anything. It's just Federal Reserve notes. But anyway, so if you're interested in this kind of thing, it's a very fascinating history of American notes and coins. I guess we'll just have to go somewhere else to find the pictures. But all right, anyway, money supply. Now, the money supply, interestingly enough, for many, many decades, the money supply was pretty stable. It was measured in very specific, like what you're seeing here, the money supply in the United States, for all practical purposes, was considered to be the amount of currency in circulation plus checking deposits. Well, you can imagine, as we were discussing before, when was the last time you either wrote a check or used cash to buy something? So it's gotten to the point where measuring the money supply is incredibly difficult for the Fed because of the technology. It was easy for many years. In fact, if you look at the Fed database at the St. Louis Fed, if you look this M1 number, they, oh, there it is. Okay. I think somewhere along the way, they had to change the way they defined it. But according to this, M1, which for all practical purposes is currency in circulation plus checking deposits, it's about $18 trillion. Does that sound like a lot of money? Yeah, it is. Well, considering that that's maybe two-thirds of the size of the economy, that's a pretty nice chunk of change. They also have a couple of other related measures, or they did at one time. They may have abandoned. I saw them too. Okay. Oh, there it is. Now, as we'll see in the slides, M1 is the most liquid form of money. It is just essentially currency plus checking deposits with a few other small items. M2 is M1 plus more items are added to it. Specifically, it tells you here it's M1 plus small denomination time deposits, meaning relatively small savings accounts. Retail money market funds. So it's slightly it's larger, but it's less liquid. So mostly when you see the money supply discussed in the media or in a textbook, let's say, they're probably talking about M1. That's the most commonly used measure. They also have a few others, like they used to have an M3. I'm not sure if that's still being published. Yeah, they stopped. It looks like they stopped printing that in 2023. It's just not important enough. And they had a few others, but M1 is really the most important one. That's the one that they usually look at when they conduct monetary policy. Now, here we have a related measure called the monetary base. Now, this is important because the Fed doesn't actually directly control the money supply. Um, the money supply depends on other factors. For example, how much currency are people holding? How much are the banks lending? The activities in the marketplace determine the money supply. So the Fed only has an indirect control over it. But this monetary base is directly under the control of the Fed. Now, if you notice, it has C, currency in circulation. The Fed is the one that determines how much currency there is. Um, as you know, because we talked about the other day, all those dollar bills in your wallet were ultimately issued by the Fed. They came from, if you look at your $1 bills, it'll tell you which district Federal Reserve Bank issued it. And there are 12 of them, which I think I have a map in here somewhere, by the way. Maybe we'd like to look at it. It's kind of small. Maybe I can find one on the internet. Well, that's a little better. So you can see, there's 12 of them. And you've got Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. So if you look very carefully, you'll notice something interesting. The ones on the East Coast are very close to each other. There's a lot of them. Look at the San Francisco district. It covers all these states plus Alaska and Hawaii. Interesting. Now, the reason for that is because the Fed was created in 1913, and this map reflects population trends in 1913. In other words, not a whole lot of people lived in California before, let's say, the 1950s. Remember when the Giants and the Dodgers moved out there, it was because the trend was population was heading out west and they wanted to be where the people were. Prior to that, 1913 just didn't have a lot of people living on the West Coast or west of the Mississippi for that matter. So the districts are the same as they've always have been. They never changed them. And so that's why the map looks like this. Now, interestingly enough, there's a single state that actually has two Federal Reserve district banks, and it's not the state you might expect. It's not California, it's not New York, it's not Texas, it's Missouri. It has both Kansas City and St. Louis in it. How did that happen? Well, who knows? But this is how it's set up. So all those dollar bills were coming from these districts. They're issued into their own districts. And when they wear out, which they do, they go to the Fed. The banks take them out and send them to the Fed, and they get not burned or anything like that. They're shredded at facilities in New Jersey. In fact, um, I thought I had one floating around here somewhere. If you go to the Federal Reserve Bank of New York, at least, you'll get a little souvenir. It's a little plastic bag filled with shredded dollar bills. Oh man, hold on one second. I might be able to find one if I look. Well, what do you know? I'm going to see how to show this to you best. Um, I guess you can kind of see it. There's the seal, and then that's shredded paper money. I don't know what the denominations are. I forgot. They may have told us. I don't remember. But everybody goes to the Fed, gets one of these cool little bags of shredded money. And in fact, by the way, just as a side note, if you go to the Bank of England, this cool little turtle, this is filled with shredded pound notes. But the difference being that they sell these. These are not given away. You have to buy one of these babies. But it's the same principle. They shred them up, and then that's what happens to them. But anyway, so the Fed actually does issue currency, but the reserves are the interesting part. We have to do a bit of a detour here for this. What happens is, or until recently, before the COVID, the Fed, in order to make sure that the banking system didn't run out of money, to hold a small percentage of their deposits, and I mean really like 3% or something like that, in special accounts with the Fed known as reserves. So they want to make sure, like, you may have seen that movie, It's a Wonderful Life. Well, one of the important parts of the plot was that there was a bank run where people came to the George Bailey's bank to take their money out because they were afraid that he was bankrupt or something. So in the Depression, there's a lot of that going on where people will go to these banks and try to get their money out before the bank failed. And at that point in time, there was no deposit insurance. So a lot of healthy banks failed because people just demanded to take all their money back at the same time when there's no real reason for it. So the Fed thought, here's what we'll do from now on. We'll have first FDIC insurance deposit insurance, but then we'll also have the banks set aside some of their deposits in the form of these special reserve accounts so that there's always some money available for the customers if they want it. Now, the banks are allowed to hold more than minimum reserve requirements. And these are known as excess reserves. Um, the reserves that are required by the Fed are known, as you could probably guess, required reserves. Now, these reserves, actually, throughout most of the 20th century, the reserves did not pay any interest. So the banks didn't want to hold reserves if they could help it. Then it got to the point where the Fed was paying them interest, but it wasn't very much. So here's what's actually happening with monetary policy, or one of the main ways in which monetary policy is carried out is that the Fed can encourage lending by the banks by buying treasury securities from the banks. They all have typically investment portfolios filled with treasury securities, and paying for them with reserves. In other words, imagine the Fed comes in and says, listen, we know you have this $1 million treasury bill in your portfolio. If you sell it to us, we'll give you $1 million worth of reserves. And then the banks can then lend them out to their customers, which tends to drive down interest rates. Oh, okay. And so the Fed will do this when they think the economy is sluggish, when it needs a little bit of a stimulation. Um, the Fed can do the opposite by selling treasuries to the banks and deducting the value from their reserve deposits. This reduces the amount of lending that can take place and raises interest rates. So the Fed, this is something they do on a regular basis. They manipulate the amount of reserves that are available in the banking system. Sometimes they increase the reserves, which lowers interest rates, and sometimes they reduce reserves, which raises interest rates. So that way they can keep the rate at whatever level they're looking for. So this is one approach to monetary policy that they use on a pretty regular basis. And we're going to see more of that later on in the chapter. But the reason why I mention this now is because I just want to be clear that the reserves in the banking system are controlled by the Fed. They decide what kind of reserves are required to be held in the system. Now, interestingly enough, as a side note, during the COVID, the Fed suspended the usual reserve requirements to encourage lending by the banks. Or as I said, basically, you don't want to hold any reserves, don't worry about it. Lend the money to your customers. Now, you would think that by now they would have reestablished those required reserves, but they didn't. They haven't. At this moment, they're still not required to hold any reserves. So far, the required reserve requirements have not been reinstated. So I'm not sure how that helps them carry out monetary policy, but yes, but they still can inject reserves into the banking system if they need to. It's just that it's going to be more difficult when the banks are not actually required to hold any. So the Fed does have control over the reserves in the banking system as well as the currency in circulation. So that means if they want to change the monetary base, they can do it very easily and quickly. And then it turns out that when the monetary base is increased, the money supply tends to increase, although the Fed doesn't really control the money supply, and vice versa. So in other words, if they want to increase the money supply, what they're really doing is they're increasing the monetary base. And they're hoping that it will impact on the money supply. Money supply depends on many factors. Um, the reserves held by the banking system, see held by the public, lending practices by the banks. So the Fed only has indirect control of the money supply. Okay, so that's going to make monetary policy a little bit more challenging, of course. So they don't just flip on a switch and say, listen, let's have more money or less. It doesn't quite work that way. Okay. All right. So here we go. We started to already talk about this. A brief history of the Fed. I already mentioned some of this yesterday or the other day. The Fed has only been around since 1913. It was really the panic of 1907 that really encouraged people to say, maybe we need a central bank. Um, you know, it does make you wonder how an economy could survive without a central bank, but there wasn't one from 1836 until 1913. So we did have two first earlier attempts at central banks, a much more, basic version of the Fed, the first and second banks of the United States. There's a lot of political opposition to them. And like I said, in the second case of the second bank, it was Andrew Jackson who made sure that it was not renewed in 1836. He just did not trust banks or people from the North. Um, I mean, let's just say that he had his reasons, but he made sure it was actually the president of the central bank, Nicholas Biddle, and he were like butting heads, and eventually Jackson won because the bank was abolished or it wasn't renewed, is what had happened. So you can imagine the economy was very volatile after that, and so there were a lot of depressions, recessions during the 19th century, as you can imagine. And interestingly enough, around the Civil War, there was actually a period when states could issue their own currencies, and even individual banks could issue their own currencies. So there's a different monies floating around in the United States. The notes issued by the federal government, the states, banks. In fact, if you want, I can show you an example. This one, I know I can find it because I've seen it before. Now, Stonington is a small town in Rhode Island. It's not too far from Newport. Actually, no, sorry. Stonington is, I think Stonington is technically in Connecticut. But anyway, this is a dollar bill issued by the Bank of Stonington. It is a private bank, and yet they were able to issue their own currency. And then we could probably find a picture of a New York dollar. It's right, it's near Mystic. So it's like right on the borderline between Connecticut and Rhode Island. There you go. Federal Reserve Bank of New York, $1. Oh my God. Now this is national currency. So you can imagine how interesting it must have been at that time. Now, if you've ever been, if you ever, you know where old Sturbridge Village is, that historical village, they actually have a bank there where they have the reenactors there who explain to you what's going on in the 1830s. And they, what happened in those days was that not all the dollars were equally valuable, let's just say. And so in order to make a transaction, if I brought a New York dollar into a store in Sturbridge, they're going to open up their little book and see what is the exchange rate between Massachusetts dollars and New York dollars. And because they're considered to be separate currencies, and so it could be that the New York dollar was worth more than a Massachusetts dollar or less. And that's how they kept track of all this information. And in fact, during the colonial days, every state had its own currencies, and sometimes they wouldn't accept each other's currencies at all. Um, so, so you can imagine how chaotic the economy must have been in those days. Uh, I don't know exactly when that stopped. But it was after the Civil War, and so for the longest time, I mean, all these different currencies were floating around in the United States, and so you can imagine that must have been a lot of fun. Look at that. It's just there's so many of them. Wow. So anyway, now the Fed, and yes, the panic of actually the panic of 1907. Let's just take a quick look at it in Wikipedia for a second. Not Wikipedia, Investopedia. They'll have a very brief synopsis of the panic of 1907. The banking crisis, as you can imagine, and of course, it had to do with people speculating, like during the Depression, or which kind of came much later, of course. And there were runs on New banks before we had Federal Deposit Insurance Corporation, and there's no central bank to bail out the banks that were in trouble. So JP Morgan and other financiers actually put up their own money to help bail out these financial institutions. In fact, Morgan signed a document, a note where he guaranteed the credit of New York City with his own money. That shows you how rich he must have been. He was able to guarantee the credit of the city of New York with his own signature. So that meant that people were not trying to sell New York bonds or, to prevent panic, basically. So Rockefeller and Morgan, they all got together and said, we need to do something about this. So Congress finally said, all right, let's create a central bank. And that's the result is the Fed. Okay. So unbelievable. So yeah, things were a little different in those days. But the Fed's job is to, well, among other things, regulate the banking system. So in the United States, which is unusual, banks are regulated both by the federal government and by the state governments. They have regulation coming at them from both directions. It acts as a lender of last resort. Now, that means they can lend money directly to companies that are in trouble or banks in particular. You can go to the so-called discount window. Let's say, and this happens fairly regularly. Sometimes you get, let's say, a bank in a part of the country that's been damaged by, let's say, hurricanes or something like that. So the Fed will step in and lend them money to get them back on their feet. And of course, they issue currencies we've discussed, and they conduct monetary policy, which is, of course, designed to keep the economy from having either too much inflation or too much unemployment. So we have the 12 district banks and the Board of Governors in Washington, which oversees the entire system. The system, if you notice, there's no other country in the world where the central bank has 12, regional banks. There's a Bank of England, there's a Bank of Sweden, there's a Bank of Japan. The US had to be different. They were hoping that they could have a system of central banks so that none of them would become too powerful. But of course, eventually, it didn't really work out that way. So we have a system of central banks under the management of the Board of Governors in Washington. Now, at the moment, the chairman of the Board of Governors is Jerome Powell. So when they talk about him in the press, no matter what words they use to describe him, his technical title is the chairman of the Board of Governors of the Federal Reserve System. Okay. Sometimes, I don't know, they call him the Fed chief sometimes, or, that kind of thing. The district banks have presidents. Powell is the chairman of the Board of Governors. Now, these positions, the Board of Governors are chosen by the President of the United States. They have very long terms that are staggered to minimize political influence. They get 14 years. at every term. The chair and the vice chair are given 4-year terms, which may or may not be renewed. If it's not, they usually step down rather than going back to being just a regular member. The governors set the required reserve ratio and the discount rate, which is the rate they charge the banks for loans. And the governors regulate the banking system. So they have a lot of influence. And then this is the one that you read about in the press all the time. Part of the Board of Governors is this Federal Open Market Committee. This consists of all 7 governors and on a rotating basis, 5 of the 12 Federal Reserve District Bank presidents, one of which is always the New York Fed president. So the 12 of them get together 8 times a year, every 6 weeks or so, and they have a meeting where they analyze the state of the US economy and they decide, should we raise rates, should we lower rates, or should we keep them where they are? And it's the whole thing is all cloaked in mystery, and they release statements after the fact to explain their thinking. But they're the ones who ultimately choose what to do about interest rates. So the chairman of the governors is also the chairman of the Federal Open Market Committee. So Powell is the chairman of the Federal Open Market Committee and the Board of Governors. So he's the one who comes on TV and announces what they decided to do. They set, now, by the way, here's an interesting component of monetary policy. The federal funds rate. What happens here is that the banks get together, and if at any given point in time, some banks are likely to have more reserves than they really need, and some will have less. The ones that don't have quite enough to meet their targets can directly borrow them from the banks that have excess reserves to lend out. So they get together and they borrow and lend among themselves in this federal funds market. Now, these are usually like overnight loans. These are very short loans. So the rates are very low. But it's that borrowing and lending that actually determines the federal funds rate. The Fed actually sets a target for it. Okay. And if the rate deviates from that target, they can step in and change the quantity of reserves in the banking system. So when the Fed says we're raising rates, what they're really saying is we're raising the target for the federal funds rate, or we're lowering it, as the case may be. They don't actually set the rate themselves. It is determined by the banks, but they nudge it in the right direction. In other words, they can push it up, they can push it down. And in fact, they may need to do this every single day just to keep it where they want it to be. It can deviate, but they don't allow it to drift too far away from their target. Now, at the moment, let's see if we can find that list. What the target is now. Okay, so it looks like it hasn't been changed since December of 2024. It was lowered by 25 basis points, which means 0.25%, by the way. And so it's a range right now from 4.25 to 4.50. So in other words, if the rate drifts outside of that range, then the Fed steps in and they do what they have to do to adjust it back by either adding reserves to the banking system or withdrawing them. So that's where it stands now. But if you notice, it had been higher. But of course, if you go back far enough, during the COVID, it was pretty well close to zero. Oh, it doesn't seem to want to show me too many more. And then once the economy started to wake up, they started raising it fairly quickly, and it got as high as 5.25. Now it's kind of creeping back down again. But this is normal by historical standards. This was not. This is unprecedented in US history to have such a low federal funds rate. Okay, that was an unusual case. That's why the COVID. But normally it's up in this range 4 to 5% is normal. Now, This, you wouldn't think this would have such a huge influence in the economy. It's basically an overnight rate of interest. But when these rates change, all the rest of them tend to change as well, all the way out to the 30-year yields on the treasury curve. So notice these interest rates are very highly correlated with each other. So the minute the Fed says we're raising rates, what do banks do? They raise the rate that they charge for their own loans. Credit card rates go up, mortgages go up. They all tend to go up and down at the same time. So the Fed changes this overnight rate, it has a ripple effect throughout the rest of the yield curve. So it'll have a very great impact on the economy, as you can imagine. So, yeah, I don't remember when his term expires. I have a feeling he's not going to be reappointed. That's the handwriting in the wall that I see. When is Jerome Powell term end? Oh, May 2026. Okay. All right. Well, he's got a year, but I think that's going to end. Now, in principle, their goal is to keep inflation from going much above 2%. And theoretically, everything else is secondary to that goal. Although, depending on what's going on in the economy, they have other objectives too. Um, but mostly they're trying to keep the economy growing steadily. They're trying to avoid extremes of inflation or unemployment. Um, the policy instruments they have, open market operations, or what I described earlier, when the Fed adds or subtracts reserves from the banking system by buying or selling treasuries. Those are collectively known as open market operations. They can also affect the discount rate, which is the rate that they charge the banks for emergency loans. They can adjust the required reserve ratio. And then they also have other powers that you might not know about. For example, during the housing crisis of 2008, when a lot of banks bought a lot of really horribly risky products, like mortgages, subprime mortgages, for example, what the Fed had to do is basically buy those crappy products off the banks in order to make sure they could continue lending money. Okay. So you don't see that very often. Like, or during the COVID, they had to make sure that they actually canceled the required reserve ratio so that banks could continue to lend money. So they're trying their best to make sure that during a crisis, we don't have another depression, which is caused by, the banks failing because there was no deposit insurance, they didn't have enough liquidity and all this and that. So the Fed learned from past history. Oh, here's an interesting chart. This is what the Fed funds rate has looked like going back to the early 2000s. Now, these gray lines are usually used to represent recessions. This is the housing crisis over here, and this is the COVID over here on the right. You can see during the COVID, or before, well, after the housing crisis, but before the COVID, it was very low, then it went up, then it went down, it goes up. The idea is to use it to keep the economy from collapsing. Let's see. Now, of course, that raises the question why interest rates affect the economy so much. Well, consumer spending and business investment spending are directly impacted by interest rates, as you can imagine, and they account for three-quarters of the entire economy. So if the Fed raises rates or lowers rates, of course, it's going to have a huge impact on the economy. Open market operations, as we mentioned, are where the Fed buys or sells treasuries from the banking system to influence the amount of reserves in the banking system. The discount rate is the rate charged for emergency loans. Required reserve ratio is the percentage of deposits that the banks were required to hold with the Fed, or they could hold it in the form of cash, known as vault cash. And these funds were there to help preserve the safety of the banking system, of course. Any excess reserves the banks held could be lent out to other banks or to their customers in the federal funds market. Okay. Um, all right. So I think that is enough of that. Now, officially, this is as far as we were supposed to go this week, but I'll tell you what, after we get back from the break, I think we might as well at least take a peek at chapter 5, which is 5 is our first look at, oh, it's a more detailed look at monetary policy. And so now for this one, I've gone out and captured real data. I'll show you where to find this data that'll help us understand what this is all about. Let me just open it up. Yeah, monetary policy. So we're going to look at indicators that help the Fed determine which direction monetary policy should go. So, all right. Anyway, so we'll stop for a bit. We'll come back around, say 30-ish, and then we'll discuss these indicators of economic activity and what they mean and how we can find them on the internet and understand what they're telling us about the future direction of the economy. So traders pay a lot of attention to these numbers. Because it helps them determine where interest rates are going in the future. So, all right, let's do that. Let's come back in a bit, 8:30 or so, after you've had plenty of caffeine, and we'll carry on from here. Okay. All right. So see you in a bit. All right, so we're back. So we're going to start five, although technically five is for next week, but why not? We don't want to waste time here. So we want to start on a closer look at monetary policy. Specifically, we're going to look at the information that the Fed uses to conduct monetary policy, and that refers to economic indicators, which are variables that help us understand the state of the economy. So we're going to see what some of them are. We're going to try to see how they're measured and understand what they're telling us. And also, in many cases, we can find that information directly on the internet. There's a lot of great sources for economic data that don't require us to pay for them, which is kind of nice. So, here we go. All right, so we'll start by noting that in order to properly carry out monetary policy, the Fed does rely on a lot of economic data, including indicators of economic growth and indicators of inflation. Now, of course, keep in mind what they're trying to do is keep inflation as low as possible, but they're also trying to make sure that growth is as strong as possible. So those two can sometimes be conflicting objectives. So they have to sort of walk on a tightrope to keep the economy at a level that's acceptable. And so they start with, of course, the most important indicator of them all, which is GDP. So if you're not familiar with GDP, it is an abbreviation for gross domestic product. And think of GDP for the United States economy as equivalent to the income for an individual during the year. In other words, the GDP, or gross domestic product, is the value of all the final goods and services that were produced during the borders of the country during a given year. And so you can measure it in terms of the value of the goods that are produced or the money that was spent to buy those products. Either way, at the moment, the US economy, let me just get us some numbers here. Now, what I'm going to do is show you what's called real GDP. This is gross domestic product that's been adjusted for inflation. That's the number that really is the most important because it represents our standards of living. And so you can see, as of the first quarter year, it's just about $23.5 trillion. That's a lot of money. Now, often what economists do is they'll take that number and they'll divide it by the size of the country's population and turn it into what's called real per capita GDP, which is a lot of economists feel that that's the best way to measure the standards of living in an economy. So if we were to go to the internet, we should be able to find somewhere a list of countries by real per capita GDP. Now you'll see here that because we're taking into account the size of the population, oh, this one seems to be nominal. That's okay. Nominal is the actual dollar value of what's being produced. Real means we've adjusted it for inflation. So let's see, here's the list. Now, we have number one, Monaco. Now, and Liechtenstein. Well, here's the thing. Monaco is a tiny, tiny little country, and it's actually surrounded by France. And the two big businesses there are banking and tourism, and of course the casinos. And so because it's such a small country, and because they bring in so much money from France and other countries, it stands to reason that while their total economy is not very large, on a per capita basis, it's enormous. Look at that, $256,000 a year. Liechtenstein, the same thing. Liechtenstein, their economy is heavily based on services like insurance and banking. It's a very wealthy country, considering how small it is. And so because of that, you can see their per capita GDP is 186,400. And same thing with Luxembourg. Bermuda is one of those countries that has a very small population, and a lot of their revenue comes from tourism, but also insurance, as it turns out. And then we work our way down the list. The United States actually is only number 7 on this list. Um, Let me scroll down. We can see, then we get down into this area. France is pretty far down the list. They're only at 22. Surprisingly enough, Italy is 27. Spain is at 29. So anyway, so this is per capita. Now, the total, though, if we list countries just by their GDP, nominal GDP, that is, this is just the total, and you'll see the United States is way, way ahead of everyone else. At 30 trillion, that's in nominal terms, by the way. China is second at 19, although they are catching up. And Germany is only at for just under 5 trillion. So in other words, Germany's economy is about 1/6 of the United States. And then you work your way down to all these Western European countries. So in terms of just total GDP, the US dominates by a long shot. Now, this is the number that's really important because, like I said before, once you adjust it for inflation, this really does represent our purchasing power. Okay, this is how much we have to spend. And so this is the number that we want to maximize. We want it to grow as quickly as possible because that's what determines our standards of living. So the Fed keeps a very close eye on what's called real GDP growth. All right. So let's see if the Fed has real GDP growth here. There we go. I didn't know they had a blog, the Fred blog. Oh, I'm not sure what this is. Oh, I see what they've done. They've broken it up by states. No, but I wanted to compare it to other countries. Uh, oh, no. Well, anyway, the bottom line with real GDP growth is their goal realistically is to get real GDP growth to be, let's say 3% would be about what we're looking for. 3% means the economy's growing steadily, not so fast that inflation is rising, but not so slowly that unemployment is rising. So if they can achieve 3% in real terms, that is absolutely fantastic. Even 2 is quite good, but 2 to 3, that's what they're aiming for. So, yeah, all right, let's see what we can do here. Oh, I get it. They want us to pay for it. All right. So you can see the yellow means it's a severe depression, recession or depression. That was the COVID. This is the bounce back from the COVID. And you can see, yeah, there's some very strong quarters here, but on a year-to-year basis, realistically, the best you can hope for is, let's say, 3-ish. Now you might say, well, 3% doesn't sound like a lot, but that means that the economy is doubling in size every 25 years or so when you reach a 3% growth rate. So every generation, the economy is doubling if that's what you're doing. So that's actually quite impressive. So anyway, the Fed is watching that very closely, among other things. And in fact, when you hear about the business cycle, when they talk about recessions and recoveries and all, what they're specifically referring to is real GDP growth. That's what is bouncing up and down over time. And that's what they're keeping their eye on. Okay. Now, unemployment is another, of course, big one. Now, unemployment is very difficult to measure properly. It turns out that there's actually 6 different measures of unemployment published by the U.S. Bureau of Labor Statistics. The one that you hear about in the press is called U3. So if you look at the Bureau of Labor Statistics website, they have definitions for all of them. You can see, for example, U3 is total unemployed as a percentage of the civilian labor force. Okay. And by the way, the civilian labor force means that it does not include military personnel. Um, it does not include people who are voluntarily unemployed, meaning, like, for example, people who are retired, people who are in school, that type of thing. Only the official or the civilian labor force only includes people who are theoretically available for work. Okay, so like if you offered them a job, they'd be in a position to take it. So it only counts the labor force. And then, the tricky part is defining what does it mean to be unemployed? Okay, now, see, because, you can have people who are working part-time, and there's people who've been laid off, and there's people who have seasonal work, and there's people who are trying to find a new job, and there's people who are not trying to find a new job. You might remember, for example, in Seinfeld, there's an episode where George Costanza was doing everything he could to stay unemployed as long as possible. He did not want to go back to work. And so, he would have not technically been counted as unemployed because he wasn't making much of an effort to look for new work. So you can see we have different types of unemployment here. Like U1, for example, is people who are unemployed 15%, 15 weeks or longer. And 2 is job losers and people who completed temporary jobs. 4 is unemployed plus discouraged workers, which means they've given up looking, but they don't have a job. Unemployed U5 is you add to U4 plus people who are just sometimes accepting part-time work, that type of thing. So in other words, each one of these U's adds more people to what's defined as unemployed. Okay, so that means that the unemployment rate for U6 is the highest, and for U1 it's the lowest. Okay, so like I said, U3, the one you hear about in the media, is this one, which is actually, here's the new one, 4.2%, which sounds a little high, but that's what it says. Okay, and even here, unemployment, it used to be that economists considered that they basically define different kinds of unemployment. Okay, so let me just quickly run through that with you. We have cyclical, which means people are unemployed due to the business cycle. We have frictional, which means temporary unemployment, meaning people are in between jobs. So like, let's say your company goes out of business and it takes you 6 months to find a new job. In between, you might be considered frictional because it's really only a matter of time before you go back. And then, but it's not because of the economy necessarily, unless the economy is in a recession. It could just be that your company went out of business and that was it. And then we have something called structural, which is due to lack of marketable skills. So these are the people who are unemployed, not because the economy is not doing well, but because they don't have the skills that it takes to get a job. They might have dropped out of high school. They might not speak English. They might have been in jail. People who have real hardcore issues that prevent them from working. That type of unemployment is independent of the business cycle. So, and so is frictional for that matter. So really, when the Fed is trying to figure out how much the unemployment rate is, it's really this one that they're focused on. There's people who are out of work because there's a recession going on. This is what they're aiming for. They're trying to keep this as low as possible. Now, having said that, because of these two, the existence of these two, unemployment is realistically never going to be zero. It's not like inflation. Inflation can go to zero. It does occasionally happen. It's rare, but it does happen. Unemployment is different, due to the existence of frictional and structural unemployment. Now, the sum of these two, the unemployment rate due to these two factors, is often known as the natural rate of unemployment. Okay. So in other words, this is the number that you want all unemployment to fall into this category, ideally. So historically, economists considered to be about 5%. So now, of course, in recent years, we found that that may not necessarily be the case. There have been extended periods when the unemployment rate was 3 or 4, which means the natural rate can't be 5. So, it's hard. I guess they have to do research about this. The hope is that, technology is reducing the time that it takes for people to find a job here, and maybe somehow it's helping people with less marketable skills find new jobs. Some of this is not even just lack of marketable skills. Sometimes you have people whose jobs become obsolete. That you run into that too. People who were in a business that no longer exists or is no longer very important. Now they have to be retrained to do something else. I think of a good example of this. See, what industries have disappeared? Um, well, like skills that were very specialized, and now all of the demand, those products are being produced in foreign countries, let's say, for something like that. So in other words, trade can cause a lot of this too. For international competition can lead to a lot of structural unemployment. So the good examples, textiles are not usually made in the United States anymore. So if you were somebody who was let's say somebody who made clothes for a living or something, your job probably would have disappeared because of international trade. But anyway, so we can go to Fred now if you want and take a look at the recent unemployment rate in the United States. So if we just ask for unemployment, it'll almost certainly give us back U3 without being asked. And you get the idea here. Now, like right now, we're looking at low 4s. Oh, according to this is New York. Oh, I didn't notice that. That might be why it's so high. I think for the whole country, it's lower than that. There it is. It's around 4-ish. Like I said before, that means that calls into question whether or not the natural rate of unemployment is really 5. But you can see in the past, like these gray lines, remember, they represent recessions or some other crisis. And so you can see that the unemployment tends to peak right at the end of that crisis, and then it starts to fall down to more normal levels. Like here, this is the housing crisis. This is 2001, we had a nasty recession. Um, the early 90s, early 80s. Yeah, you can see, I mean, there's recessions on a pretty regular basis. This is the nature of capitalism. But the Fed is trying to keep this minimized. You can be sure that during the 19th century, when there was no central bank, the recessions were much more frequent and much more severe than they are now. There's a limit to how much the Fed can do. But anyway, unemployment and GDP are two of the more important indicators of the health of the economy. CPI, inflation. Now, how is inflation actually measured? Inflation can be measured in multiple ways, but the one you see the most often is the CPI, or Consumer Price Index. Okay, so the Consumer Price Index is calculated by the Bureau of Labor Statistics, and the data is right here. Um, and what they basically do is they have sat down and done research, and they've decided or chosen a large quantity of goods that they believe are normally consumed by what they define as an average urban family of four. And so this is the definition they've been using all along. So they have written down, they have a huge list. Well, here's the things that people in this category tend to buy, and how much of each. So in other words, they have things in there like cars and, you know, groceries and, medicine and all this and that. So they average that out and they come up with a single number that represents the cost of living for the average American family. And so every month a new number is published. In fact, maybe we'll take a look at this thing. Actually, there's no need for that. I've already downloaded this. I just remembered. So this is in Brightspace. You can look it up if you want. It's This is what it looks like. So they're numbers. Now, somewhere in the middle here, in the early 80s, at some point it reaches 100. That by definition, they've chosen that to be the so-called base period or base year. And so all the other numbers are measured with respect to these. The right about here would be 100. The middle of 1983 would be 100. So that means that right now we're looking at 320.795. So that means prices in the United States are approximately 3.2 times what they would have been in the early 80s. And so what they'll do is they can tell us how much inflation has gone up by taking here, for example, the percentage change from this year's CPI, this month's CPI, compared to last year at this time. And that's approximately 2.3%. Okay, so in other words, the CPI in 1 year went from about 313 to about 320, and that's an increase of about 2.3%. So this is how inflation is reported in the media. What they're really referring to typically is the percentage increase in the CPI compared to last year at this time. So if you go through the whole list, going back to the base year, the average increase during this period has been about 2.9% per year, which is a little higher than the Fed would like to see it. Their target is actually 2%. But of course, it's a little deceiving because that means there were many years when that's exactly what happened. And then there were some periods when inflation was quite a bit higher than that. But it's averaged out over the last 40 something years to about 2.9% per year. So when you plan for your retirement, you can take into account how much you really have to allow for higher prices by looking at this data. So now, if you wanted to, you could take a step back. You can go look at a list of all the goods and services that are included in the CPI calculations, and they really have a little bit of everything. It's something like 8,000 goods and services are included in this calculation. And they have to go out and they have to look at the numbers. They have to find these goods in the stores. They have to figure out the new prices. It's a lot of work to put this thing together, but they do it because we need it. We have to have this information. Um, in fact, it's interesting. You would think that, this idea of looking at economic indicators is something that's always been done, but it really only got started during the Depression. If you wanted to know, for example, what was the money supply in 1920, you're probably not going to find it. I mean, it just wasn't done. Numbers now are everything in the government. They have all these numbers, and but it took a while before it became clear that this was necessary. So this is CPI. It is the measure of consumer price inflation. And some contracts are tied to this, like Social Security. When you get a raise in Social Security, they're basing it on CPI. But we also have this other interesting measure called PPI, Producer Price Index. Now, this is different because this is an attempt to capture the cost of producing goods and services. All right. In other words, the inputs into the production process, like raw materials and things like that you and I don't normally buy. Why does this matter so much? Because typically, if the PPI starts to go up, it means the cost of producing goods and services is going up. And that means down the road, CPI will almost certainly go up as well. So when traders see this, they see the PPI going up unusually rapidly. That's a very bad sign. That means inflation will probably be higher than usual in the future, and the stock market is going to suffer as a result. They probably, let's see if we can find it in Fred. Now, this one can change pretty dramatically from one month to the next. Like if oil prices suddenly start to spike up or something like that. But so right now it's at 253. I'm not sure what the base year is for PPI. I guess it's in the same period. So that means producer prices have only gone up about 2.5 times as opposed to 3.2 for consumer prices, which is kind of strange. But so the PPI is considered to be a leading indicator, meaning that it's sending us signals about what might happen in the future. Now, oh, by the way, if you're not sure, let's say you really want to look at these numbers every month or every quarter, as the case may be, and use it to decide what stocks maybe to buy or sell. There's the Fed. Actually, no, there's an organization called the Conference Board where you can look up all these numbers. Well, first, let's look at this calendar of this is published by the Fed, although everyone has their own copy of it, the Market Watch, for example. And what they're giving us, they're saying, listen, if you're a trader, here's what's coming up this week. And God, I should have known better. So, for example, on tomorrow, on the 27th, durable goods orders came out. Now, durable goods are the ones that are very expensive and are usually financed with credit, like cars and appliances and furniture and stuff like that. When this one goes down, that might not be such a good sign. It might mean that people are nervous about the future. So they said here, the forecast was negative 7.8. It was actually negative 6.3. So in a way, that could be considered good news because it didn't go down quite as much as expected. We also have this thing called consumer confidence. It's put together by the conference board. It's a number that tells us how comfortable or confident people are. So this one actually was quite positive because the forecast was 86. It had previously been 85.7, but it actually went up to 98, which means that people are feeling pretty good right about now. And that's a good sign. That means they'll spend, and it means the economy will grow. So if I'm a trader and I see this number, I might just buy some stocks. Now here we find out what the Fed was discussing at their May meeting. Jobless claims, that's a big deal. That's people who are filing for unemployment for the very first time. So in other words, if you just got laid off and you want to get unemployment insurance, you'd be in this category. So this is pretty normal to get in the low 200,000s. And then now here's an interesting one, GDP first revision. GDP is a very complicated thing to estimate. And so it comes out every quarter, but every month they issue a preliminary estimate and gets revised twice before they finalize it. So the first revision of first quarter GDP, which ended in March, is to be down 0.2%, where the forecast was down 0.4%. So again, it's not positive news, but it's better than it could have been. So you've got all these numbers, and then here we go. These are not out yet. PCE index, this is another inflation measure. Consumer spending, personal income. So all of these will come out on Friday or tomorrow, actually. No, tomorrow's Friday. And that could have a huge impact on the market if these are either disappointing or if they're optimistic looking. We have retail inventories, all kinds of measures that would help us gauge the future direction of the economy. So these will be used by the Fed to decide if they should cut rates, and they'll be used by traders to determine what they should be buying in the market. All right, anyway, so let's get back to this for a second. Oh, and I mentioned this just a second ago. PCE is another, the personal consumption. This one focuses on a different set of goods than the CPI. Wages, price of gold. The price of gold is interesting. It tends to do well when the economy is struggling and vice versa. Maybe Fred has this. It's not what I oh no, they're trying to sell us coins. See, now, if the San Francisco Fed was working properly, we could have looked at some of these on their website, some of these cool historical US coins that were made out of gold. But no. Yeah, look at these. Yeah, 3480. Well, anyway, so no, we should be able to find the price of gold. What's going on here? Maybe finance.yahoo.com. There we go. 33.34. But if you look at the chart, which is taking forever to load, you'll see that it's very, very spiky. It bounces around. Wow, look at that. If only we'd thought to buy it 5 years ago. Look at it. From 1831 to 33 something. Ooh, that would have been nice. Yeah, yep. Okay. All right. And then so the Fed will take a look at these. And so among the different indicators that are used by the Fed, they fall into three basic categories: leading, which means they are forecasts of what we can expect in the future; coincidence, which basically tell us what's happening right now; lagging, which means they tell us what's happened after the fact. And so the Conference Board is where you can find all these indicators. They have a lot of detailed discussion about what they are and how they're defined. Let's see if we can go there for a second. Hmm. No, I was hoping to get some tables here. Data. Oh, here it is. Ah, all data. Indicators. All right. So there's some highlights of the indicators. And they have foreign countries too. Wow, look at that. Consumer confidence went up quite a bit as we saw. I don't know what this one is. Employment. We'd have to see how they define it. Help wanted online. Um, wow, that's kind of interesting. Help wanted. Does anyone ever get a job anymore from help wanted ads? I don't know. Leading economic index, that's their creation, measure of CEO confidence. Um, calendar showing us when all these numbers are coming out. They have all this good stuff here. And they have indices where they combine them into a single number so that way you don't have to look at them individually. So this is the index of leading economic indicators for the United States. Blue is leading and black is coincident. You can see they're both pointing up, although, ooh, what happened here? That's so funny. Blue is heading straight down. Black is heading straight up. How's that? I don't know. And this is where we've been since the year 2000. You can see during recessions, it falls. And so, in other words, this is important because this shows us that there is a correlation here between these indicators and the state of the economy. Otherwise, what's the point of following them? So you can see that these indicators do drop quite sharply during recessions. And they also have shown us that red. So this is very bizarre. According to this, well, this is going back to 22. The indicators were pointing us towards a recession, which never really did happen. Um, or this one, yeah, that was a huge recession, and this one too. Um, but anyway, so these are all closely watched by traders on Wall Street, by the Fed when they make monetary policy. And there's so many of them. They're not all equally important, of course. Now, the Standard & Poor's 500, as you probably are well aware, is the index of the 500 largest stocks in the U.S. economy by market capitalization. Obviously, if that's doing well, then the economy must be doing something right. Um, let's take a look at the recent history of the S&P. Yeah. Um, See, this is the beauty of stocks. I mean, if you know nothing about anything, if you just buy stocks and just hold on to them, there's going to be some tough periods, but I mean, really, you almost can't go wrong. Look at this. So that's why, professional financial planners will recommend that people for their retirement will put a large percentage of their assets into stocks, although a very well diversified portfolio of stocks, because in the long run, it's almost impossible to avoid making money. You're not going to get this with your savings account, that's for sure. Apparently, the smaller stocks are the way the small cap stocks actually are the most profitable for some reason. But Yeah, these are all new records here that we're looking at. New building permits. Clearly, people don't, permits mean they're are tending to buy houses. Manufacturers, new orders, average unemployment claims, hours in manufacturing employment. Coincident ones, how many employees, non-agricultural payrolls, personal income, industrial production, and then lagging means after the fact. It's clear that the duration of unemployment is showing us that we've come from a recession, let's say, labor costs, inventories building up, that type of thing. And then, of course, we have this is the one that everyone's really paying attention to, the entire index of leading economic indicators, which we just saw, but here's a copy of it. And this is how you can look ahead and say, well, right about here, we were heading towards a recession, or at least that's what it's trying to tell us. And looks like it went up a bit and it sort of spiked down again for a bit. But this is the economic index of leading economic indicators, all of them together, basically. Now, of course, the purpose of watching these numbers from the Fed's perspective is to decide what to do about monetary policy. So if you read one of their announcements, like after they've had a meeting where they try to explain their decision, they'll mention all of these factors. They say, well, we noticed that this was happening with unemployment, this is happening here. And they also have what they call a beige book, which actually is about economic conditions throughout different regions of the country, because not all regions of the country are doing equally well or badly at the same time. So they do focus not just in the entire country, but on different parts of the economy at the same time. In fact, maybe we can grab. Oh, so this article was written just before they came out. Yeah, so the inflation just above the 2% objective. The Fed believes the economy is expanding at a moderate rate. Um, Markets expect the Fed to lower rates later in the year, but the uncertainty remains elevated. The May CPI data are scheduled to be released on June 11th. This week, investors will be watching the first quarter GDP revisions or updates. Yeah, all right. Well, we kind of already saw this, but this is exactly what they're paying attention to when they make these decisions. Let's go. All right. So, wait. So what's coming up after this is we're going to see. They're going to tie together, yeah, expansionary monetary policy and contractionary monetary policy. They're setting up a supply and demand framework to explain how this is actually working. And then let's see what's coming after that. So no, this will be next week. Just want to look ahead a little bit and see what's coming. Oh, money markets. Okay, we're going to start to look at different securities in the marketplace. We'll start with money markets are where the very short-term debt securities are traded. They're very liquid, they're very safe, they have very low rates of interest, but it's a massive, massive market. So we'll be taking a look at individual securities for a while now. Um, Money markets, bonds, stocks, and eventually derivatives. So, all right, so why don't we stop right about here since we're getting ahead of ourselves anyway. Now, don't forget, so I'm going to go ahead and extend the due dates on the Mind Tap for a while because, since we really just got started with that. But don't forget about it, just take a look and take a shot at those questions. Now, the way it's set up, you can work on them a little bit at a time. You don't have to do them all at once, and just make sure you save your work. And so in other words, you can look at it here, you can do it there. It's not the case you have to sit down and do it all at one shot. So you just do it when you get a few minutes here, a few minutes there, take a look, do some problems, and save them. And remember, you get 3 chances at each one, and it'll always keep the best scores. So you also have the option of running a little over with the due dates and handing it in with a very small late penalty just in case you need it. So you don't have to feel like you're overwhelmed with this stuff. So I made sure I kept the number of questions at a not excessive level, let's put it that way. So, and yeah, it'll take a little time to get used to it, but do what you can. And I'll see you all next Tuesday. All right.
Thank you. Have a good night.
All right. Good night, everyone.